Just disclosure, I'm not like a liquidity expert per se, but like I'll just go through each chart and kind of tell you what I see. But yeah, so this is the HEX USDC 0.3% pair. And so let's see if I can zoom in just a little bit more for you guys to see. And I think this one you can, yeah, let's do that. Yeah, let's do that. Is not zooming in? Okay, whatever. So this is the 0.3% pair. And if you're moving left, you'll notice the price is going down. And if you're moving right, the price is going up. So everything on this right side of the red line is solely HEX locked up, and everything on the left side is USDC. So you can think of all of this as support and all of this as resistance. So from a liquidity standpoint, in this one pool, price can reasonably support up to about 7.6 cents. And what I mean by support it is that like there's enough liquidity there where larger players would not incur as much slippage. So like each of these bars is about, it looks like 300,000 HEX on the right side, and on the left side it's about 23,000 USDC on each side of each of those bars. So like in total of all of this is a couple $100,000 worth of liquidity in this range where you can trade on without incurring much slippage. But well, these are still kind of low liquidity, especially compared to here where it's like 35K per bar. But say you go here where it's like $5,000 to $6,000, you're going to incur more slippage on this specific pair. So its price moves easier in these smaller ranges and it moves wider in these larger ranges. Because of that, price tends to want to be in the area where there's the least amount of slippage and the most amount of liquidity, because people want to trade in those ranges because they're incurring less slippage. As we get to higher ranges of low liquidity, it's easier for it to sell down, and generally large players actually wait for people to sell it down to get into these higher liquidity ranges so they can accumulate more easily. So low liquidity acts both as like resistance, but also it can like be a catalyst for price go up and price go down volatility. So the 0.3% pair is like the liquidity within this height of histogram is holding up to be about 7.5 cents. And over here, a little bit, it's less liquidity, but like 8.9 cents. So based on this chart, 8.9 cents is like reasonably where the price could go up to before we incur a crazy amount of slippage. But on the flip side, we have support all the way here at this 5.4 cent range in this specific pair. So price can reasonably go down back into the 5 and even all the way down here to the 3 cent range over here. So that's like what this pool is showing, the range of potential prices that HEX could be at. But that's just one pool. Does that make sense?
Yeah. So the range, so just trying to use this as like reasoning in your mind that you're saying based on liquidity pools, it reasonably shouldn't go below 3 cents. That's what I'm saying?
Correct. It shouldn't go below 3.2 cents. And it shouldn't go higher than 8.9 cents. These are the ranges that the current liquidity in this one pool. So there are multiple pools. There are 4 pools I have pulled up. So the one pool, that's the range generally it looks to that it can support. Now, of course, liquidity is dynamic, and because it's dynamic, this can change literally at any moment, right? Like, for example, the Hedron OA wall was pulled, and the entire liquidity dynamic changed once that wall was pulled. The same thing can happen here. But at any given moment, you can look at a snapshot in time and have a reasonable expectation of what's possible with price. This is the 1% pool, so yeah, it is cool. It's a nice complement to the charts. I think people like Axis do offer valuable analysis based on the data that price charts give, but I think that kind of analysis is even more powerful when it's bolstered with the liquidity data. Personally, that's my personal opinion. So here, or set the zoom, this is the 1% pool with USDC, and you'll notice that it's a much tighter liquidity with much more liquidity locked in each bar. So each of these bars is about almost 200K HEX, and each 200K USDC, and up here is about 2.7 to 3 million USD, 2 million HEX, 2 to 3 million HEX in each of these pools. So it's in a tighter range, but the liquidity is thicker, so the slippage is low. So a lot of the HEX being traded actually is more within this range, which goes from 5.7 cents all the way up to 7.4 cents. So that's about right here, all the way down to about right here. So actually that's really interesting. So that whole band of liquidity is between here and about right there, which is kind of in this low liquidity area here, but routers are bringing it through this pair because there's more liquidity. So this pool makes it look like we don't have much liquidity in the USDC pair, but if you take into account the 1% pool, we actually have a lot of liquidity in this area supporting price, allowing people to accumulate at these levels.
And is there a way to tell how much somebody would have to, or how much would have to be sold in order to get it down to, 3 cents, 4 cents, that range?
Yep. So you would want to look at every single one of these bars that is to the left of the price, and you want to add all of it up. So all of this, let's see, this is 1, 2, 3, 4, 5, 6, 7 bars right here. So just in this chart, it's 7 times it's just 180,000. So 180, 1, 2, 3 times 7. So we have $1.2 million of bid support on this specific pair, from what I'm seeing on this chart, based on the USDC that's locked. And then you do the same here. You add up all of this USDC to see how all the way down to 3 cents. You'd add up all that liquidity, and that's how much you would have to sell in a single market order to pull all of that down. If you're just analyzing the USDC pairs, there are also Ethereum pairs as well that the routers will move your order through if these areas start to incur a high amount of slippage. Does that make sense?
Yeah. Every time you say incur, I just think of all the spam comments. It's, the ones that are like, how can I trade without incurring much loss? And it's got like 42 replies to it. Every time I hear the word incur, it's been poisoned with the spammers now. But
I don't know. I've made $10,000 trading this week by looking at Monica's trading course. Oh my god!
Link in the bio.
Dude,
link in the bio.
You take her course. I took it. I made $15,000 this month. Oh my gosh, that's funny.
It's goofy spammers, and they just don't go away either. Wow. Right. Okay.
But then you can do the same analysis on these Ethereum pairs too. So all of this is bid support. All of this is resistance or sell side liquidity. And in the 0.3%, you're seeing it more spread out, a lot more bid support, a lot less resistance. And over here, again, you're seeing a lot more bid support and a lot less resistance. Generally, like we're teetering at the edge of the upper bands of the liquidity, because every time we get out of it, it's like being sold down because it's easier to sell it back because there's less liquidity. But also at the same time, we're not getting those big buys outside of of the reasonable range of liquidity because large players don't want to incur slippage. So for me, like what I see here is that people are trying to accumulate HEX within the appropriate ranges, but the way the market makers have set up the liquidity, it's not allowing it to move appropriately, or it's not allowing it to move as much as like the buys that we're getting. So it's good for the large players because they're accumulating at a lower price, but price to a degree is like suppressing price a little bit. What it would take though is some FOMO to get a larger amount of retail and smaller players buying these smaller orders, because $500, $1,000, like that doesn't really incur any slippage here. So once you start to see the train rolling, the retail investors start to FOMO into the market hard, say like on a PulseChain launch, this is your last chance to get your copy, train's leaving the station. That's when something like this high volatility, low liquidity, high slippage range can get eaten to more reasonably, because that's going to be the only HEX on the market. If you look at Crispy Man's hexfire.io, his channel, he's been doing some awesome analysis on the scarcity of HEX. And like what I'm gathering from the data is basically like HEX is becoming rarer and rarer, even though you might look at the total supply on Etherscan, it's like trillions of coins or whatever. If you look down at the supply that could be reasonably sold on the market, or the circulating supply that can reasonably put on the market, it's very, very low and starting to dwindle. And then you pair that with like a deflationary T-share, like getting less and less T-shares over time. Like HEX is basically setting up to do a crazy move when the right conditions present itself, both from a liquidity standpoint, fundamental perspective, and from a network effect, Metcalfe's law kind of thing, when we get more people are entering the system.
What are those conditions, and like what would we need to see in the next, a few weeks or months in order to be like, okay, moon time?
Yeah. So one thing, the obvious one would be like, hey, PulseChain's launch in 2 days, right? Like, that's going to induce a lot of traders to buy the rumor, sell the news kind of thing, because people want to be buying it to get their copy. And then people will use that purchasing that USDC entering the pool as exit liquidity to do the buy the rumor, sell the news. The question is, how much liquidity will there actually be at that given period of time? And because a decent amount of retail will probably want to be getting on the train to get their copy, I imagine a lot more USDC will be put into the pool at that time to pump the price. You talked to Ben Cage just recently, right? And he's been talking about how it's been easy for him to sell HEX to his institutional and like professional finance colleagues. And so, and you take that and pair it with the fact that other people, like even like Access Alive, is saying he knows, like from a friend of a friend, like people are trying to onboard millions of dollars. Just like hearing echoes, I'm hearing echoes that there is a lot of money on the sidelines trying to get into this asset. And at some point, the liquidity probably won't be able to support everybody getting in with all their money, which essentially is another way of saying there's a supply shock. There's a lot of money trying to get in. There's not enough coins, which like the logic from there is that price starts to go up until it gets to a point where a market maker wants to provide liquidity to allow larger players to enter without incurring a lot of slippage. So like one thing you could possibly see is, say we start to see a lot of liquidity, say up here in the 20 to 22 cent range or 20 to 30 cent range. It's like 3 million HEX per bar. We're seeing a market maker or several market makers saying, this is where I want price to go. This is where you can buy more HEX at a better deal in terms of market order execution.